In this video, I am going to cover the 5 main ICT concepts you need to know when trading Forex. So let's get started straight away. So the first ICT concept that we're going to cover today is timing. So if we look at the chart at the moment, we have nothing on the chart that suggests when we should take a trade. But the first thing we want to do is we want to add this indicator called Asian Session Range. So what you want to do is you want to come over to indicators, you want to type in FXN Asian Session Range, and you want to select this one by Rob Minty. Once you have tweaked the settings, it should look something like this. Now we can know straight away that we have the Asian session range, the London session range, and the New York session range here. And we know when during these times or when during this price action we can take a trade. But we are going to go even further and utilize a concept that ICT taught us called kill zones. So at the moment we can see we have 3 sessions that we could trade, but we don't know when in these sessions we should trade. And if I just click this button here, we can see that these are the kill zones of when to trade. So if I just mark these out very quickly, we can see we have the London kill zone and the New York kill zone. The London kill zone is from 7 AM GMT to 10 AM GMT, and the New York kill zone is from 12 PM GMT to 3 PM GMT. And during these times we can see we get spikes of volume and where the bigger trades come. So as an example, very quickly, we can see during London session or during the London kill zone, we get this move from here to here. And during the New York kill zone, we get this move from here to here. These are both very good trades that we could have entered utilizing this timing in order to take trades where volume is in the market. The next concept we're going to go over is relevant liquidity. So as we can see, just looking at this chart, we have liquidity everywhere here. So we've got basically equal lows here, equal highs over here, etc. And so we can see there's a lot of liquidity within this market or within this section of price action. But what liquidity is relevant? So again, because we're looking at the chart there, we need to use this indicator. So if I turn this indicator on, now we can see when the sessions are active and when we know that volume will spike during the market. And then we can understand which lows and highs are significant and are part of the relevant liquidity we are looking for to be taken. So as a very quick example, we can see we have these 2 lows here, and because they are during the Asian session, we know it's relevant liquidity, and we see this move down that takes it and then moves up and then takes it again. So we've not only have we just taken the sell side liquidity from these 2 lows here, but we've also taken the buy side liquidity from this high over here. And the same goes for the rest of these highs like so. And a good example of this is, as you can see, during the London session, when it starts to close as indicated by this indicator, we have this high and New York open doesn't take the high, instead respects it because there's not much liquidity above it, and instead drives lower where it takes New York's low and then London's low. The next very important concept that we're going to cover is relevant imbalance, especially on the daily time frame. So the reason why we're going to cover it on the daily time frame is because it is the most important time frame in my opinion when looking at imbalance. So if we look at this leg here, we can see prices moving to the downside and we've left clear imbalances open, which I will mark out now. So we have one clear one over here, we have this one there, we have this one over here as well. And so we know that these areas of price need to be marked efficiently by price action, and so we can expect price to return to these areas. Just as we have over here, we had this imbalance from here to here, and price came slowly and took that imbalance out, filled it, and then moved away. So we can expect price to move back to this area. And because we know that, we can understand that when we are picking our daily bias, as soon as we get some sort of sign that price is going to move to the upside, just like this candlestick here where we were moving down strongly and then we get a bullish doji, we can expect price to then start to push up and begin to fill these imbalances like so. And I think this one over here gets filled, normal candle at this point here. And one thing to notice is that when you are marking out imbalances and expecting imbalances to be filled, just like in this example here where this imbalance, which was at the extreme of this downward move, got filled and it took a while, this can also happen. So don't expect it to happen all the time, but what we can take from this is that imbalances will get filled, although they will take a while for price to come back to the most extreme ones. The next concept that is very important that we will cover for Forex from ICT concepts is discounts and premiums. So very quickly, we know that once we have taken liquidity with ICT concepts, we can expect price to pull away, leave an imbalance, and then we want price to come back to it. Now, when doing so, a very good tip is to use that swing that pushes down and that took liquidity and apply this tool here. So this is just a modified Fibonacci tool where I've only got the 50% line marked out along with the 0 and the 1. And the reason we do this is because we want to see what price within this leg to the downside is in a premium, and in the bullish case in a discount. So we don't really want to be taking trades close to the 50% or below it. We want to be taking trades in an extreme. And so essentially using ICT concepts, we would be entering off of a fair value gap that is in the extreme. And as we can see, this one would be the one we'd be looking to enter from. And so we'd enter from here with stops below, which would allow us to get into a trade that has a nice risk to reward ratio. Now, obviously, the same is true for a bullish trade. We want price to come into a discount, and then we want to enter off of a fair value gap that is within the discount, like so. And finally, this allows us to come on to what does a typical trade using these concepts look like. So essentially, as you can see, we have price in the sessions like this, and I've marked out the sell side liquidity and the buy side liquidity over here. Now what I'm going to do is I'm going to add in the kill zones. And now that we have the kill zones in place, now we can see where we can enter a trade and when we shouldn't enter a trade. And as we can see very nicely, we got price first take sell side liquidity. We then know it's going to take buy side liquidity, so price takes that. And then we move away, and we understand that as soon as price takes buy side liquidity, we actually get a fair value gap that we can look to enter on. And now we're looking for price to come into our New York kill zone. And so New York kill zone is just there. Price comes in. This is our entry, like so. Stops would for me be above this high over here, so that's 12.5. Let's just go 13 pips, and then we will take it to the low over here. So as you can see from this trade, we would get a nice 4.37 risk reward. And obviously looking to the left, we see that price pulls down and fills this imbalance, which will be a nice target just to the left there. Again, obviously the opposite is true as well. So with this marked as buy side liquidity and this marked as sell side liquidity, we have that the trade would also be true in this case as well. Thanks for watching. Make sure to subscribe, give this video a like, and I will see you in the next video.